So a legacy bank, like one founded before the American Civil War,
Right.
just delivered this massive 25% jump in quarterly profits.
Right.
I mean, we are looking at $6.4 billion in net income.
Yeah, that's billion with a B.
Exactly. And the underlying health of the business looks bulletproof, right? Loan growth is surging. They just announced literal billions in stock buybacks.
Oh, massive capital returns, yeah.
But then the moment these numbers hit the wire, Wall Street algorithms just triggered a massive sell-off. The stock absolutely tanks.
Which is wild.
Financial media goes into a complete frenzy. And literally all of this panic was over this microscopic 4 basis point drop in one specific profit margin metric.
Yeah. It really is, it's the ultimate paradox of modern financial markets, isn't it?
It really is.
You have these high-frequency trading algorithms, and they're parsing this highly complex earnings transcript in, milliseconds.
Right. Just skimming for keywords.
Exactly. They're reacting to single data points completely out of context and just, completely ignoring the structural reality of the business.
Which is exactly why we're pulling out the magnifying glass today. Welcome to the deep dive, everyone.
Yeah, let's get into it.
We are taking a definitive, really data-forward look at this highly anticipated Wells Fargo Q2 2026 earnings call. We're putting our Talk Tickers philosophy to work for you, the retail investor.
That's the mission.
Right. We're going to strip away all that algorithmic noise. We're going to translate the dense Wall Street accounting jargon into plain language.
Good luck to us on that one.
Hey, we'll do our best. And we're going to take a firm, opinionated stance on what these results actually mean so you can walk away with a real, actionable framework for your own portfolio.
Because honestly, the gap between short-term institutional panic and long-term structural transformation, that's where the retail investor finds actual alpha.
Exactly. The real returns.
Right. If you understand why the institutions are selling and you can prove their thesis wrong based on the company's long-term strategy, well, that's where you find the mispricing.
And I got to say, the mispricing here feels massive.
Oh, absolutely huge.
So let's anchor this discussion with the raw ground truth, okay? Let's look at the headline numbers straight from the transcript.
Hit me.
Okay, so diluted earnings per share came in at $2 flat. $2. That's that 25% year-over-year increase we mentioned, which honestly should have had the market throwing a parade.
You would think so, yeah.
And total revenue grew 9% year-over-year.
Yeah.
But to really understand that revenue, we always have to, split a bank's income statement right down the middle.
Right, the classic split.
Yep. So on one side, we have net interest income. That's a traditional banking business, right? Taking deposits, making loans. That rose 5% to $6.5 billion.
Solid.
And on the other side, non-interest income. So the fees, the wealth management, the trading desks, that just soared up 13% to over $10 billion.
Okay, but before we declare that $2 EPS a pure, unadulterated victory, we actually have to perform a little bit of forensic accounting here.
Here comes the fine print.
Always, right. Because when you read an earnings print, the headline number is almost always a composite of operating reality and accounting artifacts.
Right.
And management explicitly noted that this specific Q2 result included $132 million of discrete tax benefits related to the resolution of prior period matters.
Okay, wait, let me set the baseline here for the listeners, just so we're all on the same page.
Sure, break it down.
When a corporation calculates its earnings, it makes an estimate of what it thinks it will owe the IRS.
Right, they set aside a reserve.
Exactly. And sometimes, years later, an audit finally concludes or a long-running tax dispute gets resolved in the company's favor. The IRS essentially says, hey, you overpaid, or actually you don't owe this.
Which is a nice letter to get.
A very nice letter.
Okay.
And so the company gets to release those reserves back into their current quarter's profit. So this $132 million translates mathematically to exactly 4 cents per share. Wall Street, the consensus estimate, expected $1.98. The bank reported $2. So the algorithms flash a big green beat on the terminal and just buy the momentum.
Exactly. But a fundamental analyst, a real human reading the transcript, they strip that 4 cents right out.
Because it's not real growth.
Right. A discrete tax resolution is entirely backward looking. It's a one-time windfall. It tells you absolutely nothing about how many loans the bank originated this quarter.
Right.
Or how much fee revenue they actually generated. It is simply not recurring operational profit.
Got it.
So if you strip it out, the core run rate EPS was actually $1.96.
Okay, so it was a miss.
Well, technically, yes, against the 1.98 estimate. It's still a very strong number in isolation, but it really highlights the danger of trading purely on the headline beat, without doing the autopsy on the actual income statement.
Yeah, I mean, it's basically the corporate equivalent of finding a crisp $20 bill in your winter coat from last year.
That's a great analogy, yeah.
Like, sure, it increases your net worth today, but you can't base your monthly household budget on the assumption that you're going to find a 20 in your pocket every single Tuesday.
Definitely not.
You have to measure the recurring paycheck. So let's look at a metric that actually measures the operational engine, okay? Return on tangible common equity, or ROTCE.
The big one.
Right. They hit 17.7% this quarter. That is a massive leap from 15.2% just a year ago, and it's tracking perfectly to management's medium-term target, which they set at 17 to 18%.
And I would argue that specific metric is probably the most critical number in all of banking.
Yeah, let me break down why it's so critical for everyone listening. You can think of ROTCE as the miles per gallon rating of a bank's internal economic engine.
Okay, I like that.
So the equity part, that's the money shareholders have actually left inside the business. But we specify tangible equity because we have to strip out all the intangible phantom asset.
Like goodwill from past acquisitions, things like that.
Exactly.
Right.
We only care about the cold, hard cash and physical assets the bank actually has in its hands to work with.
Right.
So if a bank has a 17.7% ROTCE, it basically means that for every tangible dollar of shareholder capital sitting in the vault, the bank's machinery generated nearly 18 cents of pure profit over the course of the year.
Right.
And in the highly regulated, super capital-intensive world of banking, an engine running at nearly 18% efficiency. That is a high-performance sports car.
The efficiency comparison is totally apt, especially when you pair it with their actual efficiency ratio, which improved to 60%.
Wow.
Yeah, they actually managed to keep non-interest expenses to just a 2% increase year over year, hitting $28.2 billion. And that's despite them making these massive sweeping investments across their tech stack and their entire branch network.
Okay, but I'm going to challenge that 17.7% high-performance engine for a second.
Oh.
Because I read further down the income statement, past the headline numbers. And when we look at that soaring non-interest income segment, CFO Mike Santamassimo highlighted a very specific, glaring number.
I know where you're going with this.
$847 million in gross venture capital equity gains.
Yeah, it's a big number.
Right. And after accounting for the pieces of those startups that they don't wholly own, that nets out to $604 million, dropping straight to the bottom line. So I really have to push back on the core strength of this quarter.
Go on.
A legacy retail bank acting like a Silicon Valley VC firm and catching a massive, nearly billion-dollar liquidity event. That is not operational banking. They just spiked the engine with premium racing fuel just to pass the emissions test for Q2.
I mean, that is a totally fair critique, and honestly, management actually anticipated that exact pushback.
Did they?
Yeah, CEO Charlie Scharf was remarkably direct about the nature of those gains. He actually categorized them on the call as highly lumpy.
Lumpy. I love corporate speak.
Right, but it's true. Venture capital portfolios are totally subject to the whims of the IPO window and the M&A market.
Like, for sure.
You might go 4 whole quarters without a single startup in your entire portfolio exiting, and then suddenly, boom, 3 of them go public in the exact same month.
Right, but that lumpiness completely distorts the run rate. Like if I'm modeling future cash flows for this bank, I can't just slap $800 million of VC wins on a spreadsheet and extrapolate that outward like clockwork every quarter.
No, you certainly cannot do that. But the defense of that 17.7% ROTCE target doesn't actually rely on infinite VC windfalls.
Okay, so what's the argument?
Management's thesis is that while those venture gains will inevitably normalize, meaning, yes, they will drop off significantly in future quarters, the underlying foundational growth across their traditional lending and fee businesses is accelerating fast enough to fill that gap.
Oh, I see.
Yeah, they are essentially using this VC windfall as a bridge. It props up the returns today, while the core operational machinery ramps up to a level where it can sustain that 17 to 18% target purely on its own merits down the line.
Okay, well, we will definitely put that core machinery to the test in a minute. But let's close out the headline numbers with the ultimate metric of management confidence, which is capital return.
Yes, the fun part.
The very fun part. In the first half of 2026, Wells Fargo returned $9.8 billion to shareholders.
Incredible.
That includes a staggering $7 billion in common stock repurchases, with $3 billion of that executed in Q2 alone. Plus, they announced an 11% increase in the Q3 dividend, taking it up to 50 cents per share.
Let's unpack the mechanics of that buyback, because I think a lot of people misunderstand it.
Please do.
When a company buys back $7 billion of its own stock in just a 6-month window, they actually go into the open market, purchase those shares, and legally retire them. Like, they cease to exist.
They literally burn the shares.
Exactly, which mechanically alters the fundamental valuation of every single remaining share. Think of it like a pizza.
Okay, I'm hungry. Let's go with pizza.
If a pizza is cut into 10 slices, and the company buys back and destroys 2 of them, the remaining 8 slices instantly represent a larger percentage of the total pie.
Right.
So even if the bank's total net income stays completely flat next year, the earnings per share will artificially increase simply because the denominator, the total number of shares, has shrunk.
Which is honestly the most tax-efficient way to return capital to investors. And pairing it with a double-digit dividend hike sends a very specific signal to the market.
What's the signal you're reading?
Well, boards of directors are structurally terrified of ever having to cut a dividend.
Yeah.
It just destroys stock prices and it ruins management credibility for years.
Oh, totally. A dividend cut is a death sentence.
Right. So you do not raise a dividend by 11% unless your internal stress testing models show that you can easily maintain that payout even through a severe, prolonged economic recession.
Yeah, it is a definitive statement that they view their current capital position as virtually impenetrable.
Absolutely. So, okay, we have the raw materials now. A messy but massive EPS beat, heavily augmented by venture capital gains, and a tiny tax quirk, but firmly supported by aggressive shareholder returns.
Right.
Now we have to transition into the actual narrative driving these numbers. This is where we break down the operational maneuvers.
The story behind the number.
Exactly. Because for years, Wells Fargo was effectively in a regulatory penalty box. Following all those historical missteps, regulators placed a hard asset cap on the bank. They were legally forbidden from growing their balance sheet past a certain threshold.
Which is brutal for a bank.
Brutal. But with those constraints lifted, we are seeing the asset cap unleashed. Average loans are up 12% year over year. Average deposits are up 10%.
To really contextualize a 12% loan growth figure for an institution with nearly $2 trillion in total assets, we have to look at the competitive dynamics of banking.
Yeah, break that down because 12% on $1 trillion base is a lot of money.
It's massive. When you are artificially constrained for years by regulators, your competitors, the JP Morgans, the Bank of Americas, they just run roughshod over your market share.
Because they can lend and you can't.
Exactly. You literally have to actively turn away perfectly good loans just to stay under the regulatory limit. So lifting that cap doesn't just mean a return to normal growth. It unleashes years of pent-up kinetic energy.
Like a coiled spring.
Right. They're actively reclaiming the territory they were forced to surrender.
And we can see exactly which territories they are invading right now. Let's look at the auto lending data.
Oh yeah, this was wild.
Originations in auto loans skyrocketed 41% year over year, which drove average balances up 31%.
Crazy numbers.
Now look, for a massive consumer lending category to jump 41% in 12 months, that usually implies a reckless lowering of credit standards, right? Like they're just handing out car loans to anyone with a pulse.
Which is usually how you grow that fast.
But the transcript reveals a totally different mechanism. They aren't just spamming the market with cheap subprime loans. They secured a massive structural distribution channel.
Right.
They became the preferred financing provider for Volkswagen and Audi vehicles in the United States.
Which is honestly a masterclass in indirect auto lending.
Yeah. How so?
Well, banks generally have 2 ways to issue a car loan. There's direct lending, where you, the customer, walk into a branch, get pre-approved, and take a physical check to the dealer.
Right, which nobody really does anymore.
Exactly. It's highly inefficient. And then there's indirect lending, where the dealer acts as the middleman. By locking down the VW and Audi partnership, Wells Fargo embed itself directly into the dealership's finance office.
So basically, the customer falls in love with an Audi, they sit down with the finance manager, and the manager runs the application through their proprietary dealer portal.
Yep.
And it automatically routes to Wells Fargo. The bank doesn't have to spend a single dollar on consumer-facing marketing or TV ads to acquire that specific loan.
None at all.
The dealership serves as this highly motivated, zero-cost customer acquisition engine for the bank.
Furthermore, in these preferred provider partnerships, the manufacturer often subsidizes the interest rate just to move inventory off the lot. The industry calls it a subvented rate.
Okay, what does that mean in plain English?
Let's say VW wants to offer a promotional 1.9% financing rate to the consumer to sell more cars. Well, Wells Fargo still requires their standard 6% yield on the loan to make a profit.
So who pays the difference?
VW does. They pay the bank the difference upfront in cash. So the bank gets a high-yield safe loan, the consumer gets a incredibly cheap rate, and the dealer moves a car.
Wow.
It is an incredibly capital-efficient way to deploy billions of dollars rapidly without taking on massive credit risk.
Okay, that partnership explains the auto boom perfectly. It makes total sense. But let's pivot to a growth vector that I am honestly far more skeptical about.
Let me guess. Credit cards.
Credit cards. The transcript shows new credit card accounts surged 46% in Q2. I have to put management on trial here because aggressively scaling a credit card portfolio in this macroeconomic environment.
Yeah.
It sounds like a classic Silicon Valley burn rate trap.
It does look risky on the surface.
Let me explain the mechanics of credit card accounting to illustrate why I'm so worried about this. When a bank issues a new credit card, they incur massive upfront costs.
Right.
You pay for the marketing, the sign-up bonus, the 0% introductory period.
All the perks.
All the perks. But more punitively, under the current expected credit losses standard, the CECL accounting rule, the moment you issue that piece of plastic, you have to book a provision for all the losses you expect to take on that account over its entire lifetime.
Right.
You haven't even lost a single dollar yet. The customer hasn't even swiped the card, but the accounting rules force you to take a massive hit to your current quarter earnings right out of the gate.
You are describing the J-curve of profitability, and it is, without a doubt, the most painful dynamic in consumer finance.
Exactly. You literally draw a J on a graph. You start at 0 on day 1, and the line plunges deep into negative territory because of that CECL provision and the massive marketing costs.
Right.
And it takes years for the interest income and the swipe fees, the interchange fees, to drag that line back up above 0 into profitability.
Years.
So a 46% surge in new accounts means they are intentionally diving into the deepest, darkest part of the J-curve. They're bleeding cash today on the sheer hope that these consumers will be profitable in 3 years.
Right. They're taking a massive upfront hit.
And with inflation eating away at consumer wallets, how can they guarantee these 2026 vintages won't just default before they ever crawl out of the bottom of the J?
It is arguably the most aggressive maneuver on their entire balance sheet. But to be fair, management provided a highly specific defense on the call.
What was it?
They pointed to their historical data. The massive cohorts of credit cards they issued back in 2022 and 2023, those have fully seasoned. They have climbed up the steep side of the J-curve and are now generating significant, highly accretive monthly profit.
I hear that, but come on. 2022 was a totally different economy. Borrowers were still flush with pandemic stimulus checks and deferred student loans. I do not buy that the success of a 2022 vintage guarantees a 2026 vintage will perform the exact same way when groceries cost 30% more.
That's a fair concern.
Are those older vintages really generating enough absolute dollar profit right now to subsidize the massive upfront CECL provisions of a 46% growth spike today?
Look, if they were acquiring these new customers on the open market, your skepticism would be 100% validated.
Okay.
If they were paying, hundreds of dollars in bounties to third-party affiliate websites for anonymous internet leads, the risk profile would be terrifying.
Right, just buying random customers.
Exactly. But CFO Mike Santomassimo revealed the specific mechanism of this growth. They are acquiring these accounts almost entirely through their own proprietary channels.
Meaning their physical branches.
Their physical branch network and their authenticated mobile app.
Okay, let me unpack why that changes the math. Because customer acquisition cost is the silent killer of consumer finance.
It really is.
If a customer walks into a physical Wells Fargo branch to, say, deposit a check, or they log into their checking account on their phone, the bank already has them in a captive environment. The mobile app just flashes a little pre-approved offer on the screen. The marginal cost to acquire that specific user is essentially zero. There's no affiliate bounty, no massive TV ad spend.
And it solves both the acquisition cost problem and the credit risk problem simultaneously.
How does it solve the credit risk problem?
Because these are predominantly existing deposit customers. Wells Fargo possesses asymmetric information. They aren't relying on a generic lagging indicator like a standard FICO score.
Oh, wow, right.
They can literally see the customer's direct deposits hitting the checking account every 2 weeks. They see exactly how much the customer spends on rent and groceries.
They have all the data.
All of it. They run proprietary cash flow underwriting models that are exponentially more predictive of default than a standard credit bureau poll.
So they know exactly who they're lending to.
Exactly. So even though the CECL accounting rules force them to take a generic provision up front based on averages, the internal risk teams know the actual probability of default for these specific customers is remarkably low.
Okay, that is a very robust defense, I'll give them that.
Yeah.
They are leveraging their historic deposit franchise to bypass the open market bloodbath of credit card acquisition.
It's a very smart play.
Which brings us inevitably to the metric that caused the stock to actually sell off in the first place.
Here we go.
Net interest margin, or NIM. It declined by 4 basis points from the first quarter. This tiny fraction of a percentage point caused a multi-billion-dollar market cap wipeout.
Which is just staggering when you say it out loud.
So for the uninitiated, let's establish exactly what NIM is. A bank is essentially a raw materials processing plant. The raw material is money. They buy money from depositors by paying them an interest rate on their savings accounts. They then take that raw material, package it into a loan, and sell it to a borrower at a higher interest rate.
Simple enough.
The difference between the rate they charge the borrower and the rate they pay the depositor, that spread is the net interest margin. It is the core retail markup of the entire banking business model.
And when you operate a balance sheet measured in the trillions, a compression of 4 basis points, which is just 4/100ths of a single percent, translates mathematically into hundreds of millions of dollars in lost potential revenue.
Right.
The algorithms see the core markup shrinking, and they immediately execute sell orders. They don't ask why.
But earlier you called this an algorithmic mispricing. You suggested this isn't a sign of a struggling bank losing its pricing power, but rather a deliberate structural choice by management.
It absolutely is.
Walk me through the mechanics of intentionally shrinking your own profit margin. Why would any business on earth actively choose to make less margin on its core product?
To capture primary banking relationships in the highly lucrative corporate and institutional sectors.
Okay, expand on that.
Management is actively choosing to deploy their excess capital into lower margin financing activities within their markets division. Specifically, they have expanded their markets balance sheet by nearly $200 billion since the end of 2024.
That's a massive expansion.
It is. They are providing massive scale financing to huge institutional clients, hedge funds, asset managers, private equity firms.
Okay, let's use a tangible example to explain this for the listeners. We're talking about things like the repo market or prime brokerage financing.
Exactly.
Let's say a massive hedge fund needs to borrow $5 billion overnight to leverage a specific trade. Wells Fargo steps in and provides that $5 billion. But because the hedge fund is a massive, highly sophisticated client, they demand incredibly tight pricing.
They negotiate hard.
Right. Wells Fargo might only make a tiny fraction of a percent in profit on that $5 billion loan. The spread is razor thin. So when you add a $200 billion block of razor-thin margin business to the overall bank averages, the total corporate net interest margin mathematically gets dragged down.
Precisely. And simultaneously, they're aggressively paying top-tier interest rates to large corporate clients just to win their operational deposits.
Bidding up the cost of funds.
Right. They are telling Fortune 500 treasurers, hey, move your billions in operating cash over to us, and we will pay you a premium yield. This increases their cost of funds, which, again, compresses the NIM on the other side.
So they're squeezing themselves on both ends. They're paying more for corporate deposits and charging less for institutional financing. The algorithms see the margin compressing and just panic. But what is the strategic payoff that management actually sees here?
The cross-sell flywheel. Corporate financing and premium deposit rates are essentially a loss leader, or, well, more accurately, a low-margin leader. A Fortune 500 company doesn't just need a place to park cash. They need complex treasury management software. They need currency hedging. They need global payroll processing. And eventually, they need investment banking advisory when they want to acquire a competitor.
Okay, I see where this is going.
By weaponizing their balance sheet to provide the low-margin financing and high-yield deposits up front, Wells Fargo basically becomes the indispensable primary bank for that corporation.
I love this. It's the Costco rotisserie chicken strategy applied to global high finance.
Yes, that's exactly what it is.
Like Costco loses money selling you a whole cooked chicken for $5, but they put it at the very back of the warehouse.
You're right.
And to get it, you have to walk past the electronics and the jewelry and the clothing, and you end up spending $400 on a flat screen TV and bulk paper towels.
You always walk out spending $400. Always.
Every time. So Wells Fargo is offering the low-margin $5 billion overnight loan, the chicken, so they can win the massive high-margin fee business, the TV of managing the client's global currency risk or advising on their next massive merger.
And CEO Charlie Scharf confirmed this dynamic explicitly on the call. He stated they track the profitability of this strategy client by client.
Really? Granularly?
Very granularly. When they deploy that lower margin financing to a specific hedge fund or corporation, they are seeing a direct, highly correlated spike in trading revenue and advisory fees from those exact same clients.
So that's all working?
It's working perfectly. They are trading a few basis points of margin percentage for massive absolute dollar growth in their fee-based divisions.
Wow.
Like, if they wanted to artificially prop up their NIM to appease the algorithms today, they could just shut down the prime brokerage financing tomorrow.
And the margin percentage would instantly rebound.
Instantly. But total overall profits would collapse, and they would lose the vital relationships driving their future growth.
That complete reframing of the NIM compression totally invalidates the market's bearish reaction. It's exactly why you have to read the transcript. And it perfectly transitions us into the results of this cross-sell strategy.
Let's talk about the CIB.
Yes, let's look at the Corporate and Investment Banking Division, the CIB. The transcript reveals an absolute blowout quarter here. Investment banking fees topped $900 million. Revenue in the banking division grew 20%.
Staggering growth.
And the market share numbers are what really jumped out at me. They are now number 3 in leveraged finance, holding a 7.2% market share. They skyrocketed from number 9 all the way to number 4 in mergers and acquisitions advisory, and they captured 3.8% in equity capital markets.
Look, this represents a fundamental rewiring of the global investment banking hierarchy.
It really does.
Historically, the elite advisory tier was this impenetrable fortress guarded by JP Morgan, Goldman Sachs, and Morgan Stanley.
The big 3.
Right. Wells Fargo was viewed as a regional retail giant. They did your mortgage, they gave you a checking account, they didn't advise on your $20 billion hostile takeover.
No, you didn't call Wells Fargo for M&A.
Never. So breaking into the top 4 in M&A advisory requires more than just hanging a shingle and saying you're open for business.
Right. Let's dissect how a retail bank actually breaks into that elite tier. Because you don't jump from number 9 to number 4 purely on brand charm.
Definitely not.
When a Fortune 100 CEO is plotting a $20 billion acquisition of a rival, they demand absolute certainty of execution. They need an investment bank that can not only value the target company and negotiate the terms, but essentially guarantee the funding will be there at the finish line.
And that is exactly where the unleashed balance sheet becomes the ultimate weapon.
Tying it back to the asset cap.
Exactly. Wells Fargo aggressively poached top-tier senior advisory talent from their rivals across key industry sectors, healthcare, technology, industrials.
They bought the talent.
They bought the best talent. And then they armed these elite bankers with the massive Wells Fargo balance sheet.
So they have the brains and the brawn.
Right. So when that newly hired star banker pitches the Fortune 100 CEO, the pitch isn't just, hey, we have great ideas. The pitch is, we have great ideas and we have the capacity to write a $20 billion bridge loan this afternoon to guarantee the transaction goes through.
Wow.
That combination of elite advisory talent backed by immense guaranteed lending capacity is what actually wins the mandate.
They are monetizing the sheer gravity of their balance sheet. And we see a similar aggressive monetization happening in wealth and investment management, or WIM.
Yeah, the wealth division was fascinating.
Client assets hit $2.4 trillion, up 15%. But the metric that really caught my eye was securities-based lending, or SBL. Average balances in SBL are up an incredible 31%.
That is a very specific, highly profitable niche.
Let's break down the mechanics of securities-based lending because it illustrates exactly how banks extract value from the ultra-wealthy.
Walk us through it.
Imagine you are a tech founder. You took your company public, and you have $20 million in company stock just sitting in a brokerage account. You want to buy a $5 million estate in Aspen.
Sounds nice.
Right. Now, if you sell $5 million of your stock to buy the house in cash, you trigger a massive capital gains tax event. The IRS takes 20% immediately.
Which is incredibly inefficient capital management for a wealthy individual.
Exactly. So instead of selling, the wealth manager offers you an SBL, sometimes called a Lombard loan. They say, hey, keep your $20 million in stock right where it is. We will lend you the $5 million in cash to buy the house, using your stock portfolio as the collateral.
That's brilliant.
The founder gets the house, avoids the massive tax bill entirely, and keeps their money invested in the market growing.
And the bank.
The bank gets a virtually zero-risk loan, because if the stock market crashes, they can instantly, automatically liquidate the portfolio to pay themselves back. It is the ultimate financial cheat code for the affluent.
And the fact that SBL balances are up 31% indicates that Wells Fargo's financial advisors have become highly, highly aggressive in cross-selling these complex banking products to their investment clients.
They aren't just coasting anymore.
No, they're no longer just managing the retirement portfolio and passively taking a 1% fee. They are actively capturing the entire liability side of the wealthy client's balance sheet.
So we have established massive growth across auto, credit cards, corporate financing, investment banking, and wealth management.
A whole board is green.
Exactly. Now, logically, expanding into all these complex verticals should require a massive influx of personnel, right? Growth usually breeds bureaucratic bloat.
More business means more people.
Yet, when we isolate the efficiency metrics in this transcript, the narrative completely inverts.
Yeah, the headcount numbers are staggering.
Headcount has declined for 24 consecutive quarters. Over the last 6 years, they have reduced their workforce by 79,000 employees.
79,000. Let that sink in.
It's the size of a small city, and they are down another 7% year over year to 197,000. Operating leverage of that magnitude, growing revenue by 9% while shrinking headcount that drastically, that requires a brutal systemic rewiring of the company's internal plumbing.
It is the defining feature of Charlie Scharf's tenure as CEO.
How are they doing it?
They are taking the immense capital freed up from shedding all that payroll and ruthlessly redirecting it into digital infrastructure. They are automating the tasks those 79,000 people used to perform.
Let's look at specific examples of how they're deploying that technology to drive those efficiency gains. Because it's not just basic automation anymore. They launched a proprietary AI tool called Advisor Gateway, integrated with GenAI Cloud for their wealth managers.
Yeah, this is the future of wealth management.
Let's map out the workflow of a traditional financial advisor to understand the impact. After a client meeting, the advisor normally spends, 2 hours reviewing the client's complex portfolio, pulling disparate data streams, cross-referencing market research,
manually typing out emails,
manually drafting a recap email and a bespoke investment proposal. It takes hours of admin work. But this new AI fundamentally alters that workflow.
Right.
The large language model can instantly ingest the portfolio data, analyze the tax implications, read the latest equity research, and generate a highly personalized, fully compliant draft of the client communication in seconds.
It's incredible. You are essentially giving every single individual advisor a dedicated team of instantaneous analysts.
Right. It expands the capacity of the human advisor exponentially, which completely eliminates the need for a massive back office support staff.
And they are applying similar structural overhauls to their commercial banking infrastructure too, specifically utilizing blockchain technology.
Oh, right, the blockchain stuff.
Yeah, they are currently building out permissioned blockchain payment rails for their large corporate customers to facilitate cross-border transactions.
Which is a perfect opportunity to explain the completely archaic reality of global finance for the listeners.
Oh, please do. It's so broken.
If a corporate treasurer in New York needs to send $50 million to a supplier in Tokyo, the money doesn't just, teleport.
No.
Under the legacy correspondent banking system, the SWIFT network, the New York bank has to hold pre-funded accounts, called Nostro and Vostro accounts, in local currency at a partner bank in Japan.
Which ties up huge amounts of capital.
Exactly. And the transaction message literally bounces across multiple intermediary banks. Yeah. Each bank takes a fee. The transaction settles on a T+2 delay. meaning it takes 2 full days just to clear, and the corporate treasurer has absolutely no real-time visibility into where the money is while it's in transit.
It's just out there in the ether.
Furthermore, this entire global system just shuts down on weekends and holidays.
It is a system built on 1970s telex architecture. It's crazy.
It is.
But by migrating to a blockchain ledger, Wells Fargo replaces that highly fragmented correspondent network with a single, cryptographically secure, shared ledger.
So how does the transaction work now?
The corporate treasurer initiates the payment, the smart contract immediately validates the funds, and the transaction settles atomically instantly, 24 hours a day, 7 days a week, 365 days a year.
No weekends.
No weekends. It eliminates the intermediary fees. It removes the need for billions of dollars in trapped liquidity just sitting uselessly in Nostro accounts. And crucially, it slashes the massive back-office reconciliation teams previously required to track lost SWIFT messages.
And that is exactly how you cut 79,000 jobs without sacrificing revenue growth. You don't just ask people to work harder and longer. You eliminate the underlying frictional processes they were managing in the first place.
Exactly.
But I want to introduce a dose of macroeconomic reality here, because all this efficiency and loan growth means absolutely nothing if the underlying loans go bad.
The credit quality question.
Right. Let's examine credit quality, the ultimate foundational bedrock of any bank. If you listen to financial media right now, the narrative is universally apocalyptic.
Doom and gloom.
Rampant inflation, a housing affordability crisis, commercial real estate collapsing, consumers maxing out credit lines just to buy basic groceries.
Yeah, it sounds terrifying.
Yet, when we look at Wells Fargo's actual audited credit performance in this quarter, it borders on pristine.
It really does.
Net loan charge-offs, which are the loans they have officially given up on collecting, actually declined by 10 basis points year over year. They sit at just 0.34% of average loans.
Practically nothing.
How does a bank grow loans by 12% in this specific stressed macro environment while simultaneously shrinking their default rate? It doesn't make sense.
Because the media narrative relies on aggregate averages, while the bank's actual performance relies on granular, bifurcated reality.
Meaning what?
Management noted that both their commercial and consumer portfolios are currently outperforming their own internal stress test models. The delinquencies are coming in lower than what the bank's own highly conservative risk managers project month after month.
Okay, I need to dig into the mechanics of that consumer resilience. Why are they outperforming so heavily?
It fundamentally comes down to the labor market mechanics. While inflation has undoubtedly eroded purchasing power, nobody is denying that nominal wage growth has remained remarkably stubborn, and structural employment is incredibly robust.
People have jobs.
People have jobs. And in consumer finance, the ultimate predictor of a loan default is not the price of eggs. It is the loss of a paycheck.
That makes total sense.
As long as borrowers remain employed and their absolute nominal wages are rising, they prioritize servicing their debt. They will cut discretionary spending, they won't buy the new TV, they won't go on vacation, but they will pay the auto loan to ensure they can drive to the job that provides the paycheck.
Right. And what about on the corporate side? Because we hear constant panic about commercial defaults, specifically in commercial real estate.
Well, the commercial outperformance is driven by corporate caution. Because the media narrative has been predicting a massive recession for the last 3 years, corporate CFOs have operated in a state of extreme defensive paranoia.
They've been preparing for the storm.
Exactly. They haven't overhired. They haven't engaged in reckless, debt-fueled expansion projects. They have hoarded cash and maintained massive liquidity buffers.
Right.
So when you combine a fully employed consumer base with hyper-conservative corporate treasurers, you get a loan portfolio that absorbs macroeconomic shocks incredibly well.
So the 12% loan growth is not a symptom of Wells Fargo lowering its underwriting standards.
Not at all.
It is a reflection of them taking prime market share in a structurally sound economy.
Exactly.
Okay, we have dissected the headline beats, the intentional margin compression, the explosive investment banking growth, the technological cost cutting, and the bulletproof credit metrics.
We've covered a lot of ground.
Now, let's pivot to the forward-looking roadmap. What did CEO Charlie Scharf and CFO Mike Santomassimo actually tell the analysts to model out for the remainder of 2026?
The overarching theme of their forward guidance was unyielding reaffirmation.
Unyielding, I like that.
Yeah, they did not flinch on a single major target.
So they maintained their full year 2026 net interest income guidance at approximately $50 billion.
Right, and they provided the exact split for that. $48 billion from the core banking franchise and $2 billion from the markets division.
But the guidance number that truly stunned me was the expense target.
Yeah, this is wild.
They maintained their non-interest expense guidance at a perfectly flat $55.7 billion. And I really need to unpack the sheer operational difficulty of keeping expenses flat, given the context of everything we just discussed.
It's an incredible balancing act.
Because we established that their investment banking division had a record quarter, right? M&A advisory leaped to number 4. Leveraged finance surged. In the world of high finance, when a managing director closes a $10 billion merger, they don't get a little plaque, they get a multi-million-dollar bonus.
And it's a massive check.
That is categorized as revenue-related compensation. It is entirely variable. And because revenue is booming, that specific compensation line item is skyrocketing.
It mathematically has to. The more you win, the more you pay your top talent.
So for the total expense number to remain flat at $55.7 billion, while those specific compensation payouts are surging, management must be executing surgical deep tissue cuts to the fixed cost infrastructure.
Exactly.
They're shutting down redundant real estate, sunsetting legacy data centers, eliminating middle management layers, and they're doing it at a velocity fast enough to completely absorb the massive bonus pool they are paying out to their top performers.
Santomassimo framed this dynamic perfectly on the call. He categorized surging revenue-related compensation as literally the best possible problem a bank can have.
Because it means you're making money.
Right. You desperately want your incentive compensation to break the budget because it means your front office revenue generation is vastly exceeding expectations.
And paying for it.
The ability to fund those massive payouts entirely through back office structural efficiency initiatives rather than passing the cost on to the shareholder, that is the hallmark of elite operational discipline.
Let's address the specific metric that caused the Q2 stock drop, though.
Hey, why?
The margin path forward. Management modeled out the future of their net interest margin. They explicitly expect one more quarter of modest compression in Q3, followed by a firm stabilization in Q4.
Right.
Walk me through the mechanics of that stabilization. Why does the bleeding suddenly stop in Q4?
It tracks perfectly with the strategic pivot we analyzed earlier with the Costco chicken.
Back to the chicken.
Always back to the chicken. The margin compression is entirely driven by the right. As the volume of new lower margin financing slows down, the mathematical drag on the overall bank average dissipates and the margin inherently stabilizes.
But what about the ultimate wild card? The Federal Reserve.
Jamal.
Right. For the last 4 years, every single bank earnings call has been a referendum on Jerome Powell. Higher for longer, rate cuts, rate hikes. It completely dominates the narrative. How does the Fed's next move alter this $50 billion NII guidance?
Honestly, the most shocking revelation in the entire guidance section was the sheer irrelevance of the Federal Reserve to their 2026 operational outcome.
Wait, irrelevance?
Yeah, Santomassimo made it crystal clear that their balance sheet is largely insulated from near-term monetary policy swings.
But how is a bank insulated from interest rates? The entire banking business model is literally built on interest rates.
Through aggressive, highly sophisticated asset liability management and interest rate hedging.
Okay, unpack that.
Banks utilize complex financial instruments like interest rate swaps to lock in their margins regardless of what the Fed does.
Right, derivatives.
Exactly. Furthermore, they have a massive portfolio of fixed-rate assets, like 30-year mortgages, that are steadily rolling off the books and repricing at today's higher market rates.
Oh, I see.
Santomassimo noted that even though the Fed kept rates higher for much longer than the market modeled back in January, the delayed rate cuts essentially washed out against the structural repricing of their asset base.
It's perfectly balanced.
Right. Whether the Fed cuts 50 basis points, cuts 25, or does absolutely nothing for the rest of the year, Wells Fargo remains locked in on that $50 billion target.
Wow, that level of durability is precisely what long-term investors crave.
Definitely.
Now let's dive into a highly technical, slightly wonky, but massively lucrative element of the guidance. Regulatory tailwinds and capital requirements. We need to dissect the CET1 capital ratio.
Yes, the wonky stuff. Let's do it. Common Equity Tier 1, or CET1, is the ultimate regulatory stress test metric.
Okay, explain what it measures.
It defines a bank's core financial resilience. It measures the ratio of a bank's purest, most liquid capital, so retained earnings and common stock, against its total risk-adjusted assets.
Basically the rainy day fund.
Exactly. It is the rainy day fund designed to ensure the bank can absorb catastrophic systemic losses without requiring a taxpayer bailout.
And the regulatory minimum for Wells Fargo, which includes all the bespoke stress buffers mandated by the Federal Reserve, is currently set at 8.3%.
Right.
But Wells Fargo reported a CET1 ratio of 10.3%. They are sitting on a massive 200 basis point cushion of pure, unencumbered excess capital above the legal requirement.
We are talking about tens of billions of dollars just sitting idle.
Which is the exact capital pool funding the $7 billion in stock buybacks we discussed earlier.
Yep.
But the truly explosive catalyst hidden in this transcript revolves around the pending Basel III endgame rule.
Oh yeah, this was the bombshell.
So Basel III is the international banking regulatory framework. For the last 2 years, the industry consensus was that the finalization of the Basel III endgame would be intensely punitive to big banks.
Everyone was terrified of it.
Right. The fear was that regulators would force the megabanks to dramatically increase the amount of capital they were required to hold, which would have instantly frozen their ability to execute stock buybacks.
But management dropped a bombshell analysis on the call. Based on their internal modeling of how they expect the final U.S. implementation of the rules to be written, it will not increase their capital requirements.
Why?
In fact, it could perversely reduce their risk-weighted assets, or RWA, by a staggering 7%.
Right. This is the critical mechanism to understand, and I want to make sure everyone follows this. I will break down how risk-weighted assets are actually calculated.
Please do.
You don't just add up the total dollar amount of loans on a bank's balance sheet to figure out how much capital they need to hold. Regulators assign a specific risk weight to every single asset based on its perceived danger.
Makes sense.
Right. So if a bank holds $1 billion in U.S. Treasury bonds, the risk weight is essentially 0% because the government isn't going to default. The bank has to hold zero capital against it.
Right.
But if the bank holds $1 billion in subprime unsecured personal loans, the risk weight might be 100%. The bank has to hold massive amounts of capital against those risky loans. You aggregate all these weighted figures across the entire $2 trillion balance sheet to calculate the total RWA.
So the CET1 ratio is simply the core capital divided by the total risk-weighted assets.
Exactly. It's a fraction. Capital over RWA. If the new Basel III rules alter the standardized math, perhaps by lowering the punitive risk weights historically assigned to certain operational risks or specific types of corporate exposure, and Wells Fargo's calculated RWA drops by 7%, the denominator of that fraction suddenly shrinks massively.
And we know what happens when the denominator shrinks. The overall percentage artificially spikes. Without earning a single extra dollar of profit, Wells Fargo's capital ratio would jump even higher above that 10.3% mark, instantly unlocking billions of additional dollars in excess capital.
And Charlie Scharf made it abundantly clear what he intends to do with excess capital. He is relentlessly committed to the share repurchase program.
More buybacks.
So many buybacks.
Yeah.
If the Basel III finalization triggers a 7% reduction in RWA, the retail investor should anticipate an absolute tidal wave of stock buybacks hitting the market over the next 24 months, continually shrinking the share count and artificially juicing the earnings per share higher and higher.
It is a massive structural hidden catalyst that the algorithmic models trading on a 4 basis point margin drop completely failed to price in.
Which brings us to the culmination of our analysis. We have parsed the raw data, decoded the strategic maneuvers, modeled the guidance, and analyzed the regulatory catalysts.
We've done the work.
Now, it is time to synthesize this sprawling landscape into a definitive, actionable stance for the retail investor. The talk ticker's verdict for Wells Fargo coming out of this Q2 2026 earnings transcript is aggressively, unapologetically bullish.
I completely agree. The foundational thesis for holding this stock requires you to ignore the daily algorithmic noise and focus entirely on the multi-year transformation narrative.
Because for the better part of a decade, this institution was defined by defensive survival.
They were in the bunker.
They were navigating the fallout of historical scandals, they were operating under a suffocating regulatory asset cap, and fighting simply to maintain their existing footprint. They were a bank playing purely not to lose.
Right.
That era is definitively over. The Q2 results confirm they have successfully transitioned into a violently offensive posture.
They are actively leveraging the sheer size of their unleashed balance sheet to disrupt the legacy Wall Street hierarchy. Like we said, you do not accidentally climb from number 9 to number 4 in M&A advisory.
No, you don't.
You do not accidentally capture a 46% surge in direct-to-consumer credit card acquisition. You do it through calculated, aggressive capital deployment.
They are intentionally weaponizing their net interest margin. trading a few basis points of percentage yield to capture prime institutional financing relationships, which then feed the highly lucrative high-margin fee businesses.
The Costco chicken strategy.
The Costco chicken strategy, and they are executing this massive market share grab while simultaneously exhibiting elite operational discipline.
Stripping 79,000 headcount from the payroll.
Right. Holding absolute expenses perfectly flat despite surging revenue comp and pioneering blockchain settlement infrastructure to lower back-office friction. And most importantly, they're doing it all without sacrificing underwriting standards, as evidenced by a decline in net charge-offs in a highly complex macroeconomic environment.
So for the retail investor listening right now, the actionable takeaway is clear.
What's the move?
When institutional algorithms trigger a panic sell-off over a tiny, strategically intentional margin fluctuation, they create a pricing dislocation. They are literally handing you an entry point into a company undergoing a structural transition toward higher quality, fee-based revenue streams, fortified by a massive, impenetrable capital buffer and a board of directors committed to aggressive share repurchases.
You buy the transformation while the market is distracted by the accounting noise.
Exactly. It is a masterclass in corporate turnaround mechanics.
A total masterclass. Thank you for joining us, putting on your Talk Tickers hats and walking through this deep dive with us.
It was a blast.
But before we sign off, I want to leave you with a highly provocative thought generated during the very final moments of the analyst Q&A session.
Oh, this was chilling.
It really was. An analyst pushed CEO Charlie Scharf on the broader macro environment, asking about the buildup of systemic risk. Scharf's response was subtle, but deeply concerning for the broader financial ecosystem.
What did he say?
He pointed out that while heavily regulated, traditional institutions like Wells Fargo are playing it extremely conservatively in the wholesale lending markets, demanding massive collateral and stress testing every loan. The non-bank lenders in the shadow banking sector are currently deploying unprecedented amounts of capital into highly speculative assets.
He is referring to the explosion of the private credit markets.
Right.
Trillions of dollars have migrated away from regulated banks and into opaque private equity structures, hedge funds, and alternative asset managers.
And what are they doing with it?
These entities are financing massive leveraged buyouts and complex, hyper-expensive infrastructure projects like AI data centers, often utilizing aggressive leverage and completely bypassing the stringent capital requirements and regulatory oversight that govern traditional banks.
It's an ecosystem operating entirely in the dark. Scharf essentially issued a warning. Leverage and systemic risks are rapidly compounding in the unregulated corners of the financial system, areas where the Federal Reserve has zero visibility and zero control.
It's a powder keg.
So, as a retail investor, as you structure your own portfolio for the long term, you have to ask yourself a terrifying question. When the inevitable macroeconomic shock finally arrives, whether it's a massive spike in unemployment, a sovereign debt crisis, or a sudden technological dislocation, will the shadow banking sector's aggressive, opaque risk-taking trigger the next global liquidity crisis?
And if that shadow system fractures, the panic will be indiscriminate.
Exactly. But if that crisis hits, will heavily regulated, tightly underwritten, vastly overcapitalized traditional banks suddenly become the only viable safe harbors left in the global financial system?
It's a very real possibility.
We look at the panic over a 4 basis point margin drop today, but when you look at the actual structural reality of a balance sheet boasting a 10.3% CET1 ratio, declining charge-offs, and elite operational leverage, you are looking at an institution built to withstand a massive systemic shock.
Ready to capitalize when the less regulated competitors inevitably blow up.
It reframes exactly what safety looks like in a modern portfolio, something to heavily consider as you evaluate your positions. We will see you next time on The Deep Dive.